Right, folks, let's get the party started, as the saying goes. Right, first of all, thanks all for your patience while we just set up the presentation. We're going to be talking, following on from the topic of finding and identifying breakout trading opportunities. So one of the things that we need to discuss is how to identify a range. Now, on the blog that I've got going, we've started to address this part of the problem as well. And some of the comments that addressed there are basically to try and take into account the larger picture. Now, when we identify ranges, what we need to do ultimately is identify what phase the market is in. So there's three ways that the market can go. It can go up, it can go down, and it can go sideways. So when the market's trending, we can't obviously identify a range because the market's trending. It's making higher highs, higher lows. Conversely, when it's trending down, it's making lower highs, lower lows. So what we need to do is identify when price is neither making new highs or new lows. So for this session, what we're going to do is we're going to take a slight step back and look at something really, really basic as far as I'm concerned, and that is price action. Price action at its most basic level, and how to use that to interpret what we see on the charts to aid us in identifying the phase of the market and ultimately a trading opportunity in the form of a ranging market, and obviously to be able to trade that from a breakout potential. So we're going to be looking at price action. And what is price action? Price action at its most basic level is these little fluctuations on the right-hand side of the chart. It's every price movement that is generated. Price can tick up, it can tick down. And the way that we operate as traders is that we have charting platforms, and they allow us to cut the chart up into many different sections of the chart, whether it be 15 minutes, 5 minutes, 240-minute daily, weekly, monthly charts. We look at splitting all those price movements up into manageable data. So what we have on the screen at the moment is a 60-minute chart of pound Swiss. And what we can do is, or what the chart platform does, is obviously it breaks that down for us into 60-minute intervals. So every 60 minutes worth of price movement, a new bar is formed. So what we can do next is, now that we have a framework of looking at the data that we have in a more identifiable fashion, we can then start to try and build some layers onto what we actually see. So something that I do is identify swing highs and lows, and a swing high and a swing low for me is it's a 3-bar combination. It's a bar preceded and succeeded by lower highs for a swing high, example there, and a bar preceded and succeeded by higher lows for a swing low, example there. So it's a 3-bar combination, 3 completed bars. So lower highs, so a bar preceded and succeeded by lower highs, and a bar preceded and succeeded by higher lows. So what we're starting to do now is to build a layer upon which I can identify whether price is swinging higher or swinging lower, or ultimately range bound, and that is making neither new highs or new lows on the chart. So one of the things that we can now do is start to identify those swing highs and swing lows. So very laboriously, I'm going to mark up some. So we've got swing lows there, for example, swing high. So we can see that price is ultimately trending higher. So we've got swing low, swing high, bars preceded and succeeded by higher lows and lower highs. Now within this phase of the market here, we can see that price is making lower highs, higher lows within the previous swing high and the previous swing low. So we've got the previous swing high, the previous swing low. So when we come to the trading session at about 7 o'clock in the morning, we can see we've got a lower high and higher lows. Let me just mark those up. So we've got lower high there, we've got lower high there, we've got higher lows. So what we start to do now is start following the sequence through. We've got higher low over here on the left hand side of the chart. We've got a higher swing high and a higher swing low. So moving into the overnight trading session, what we have is prices making a lower high and a higher low within the previous swing high and the previous swing low to be made. So straight away we've identified the price is range bound. It's not making new highs, it's not making new lows. So what we have now is a picture of what's going on in the market. Now we did see a breakout attempt to the downside, as you can see there with this last bar. Now if we're looking for a breakout pullback before we pullback setup, before we actually look to take that trade on board, then we're allowing the market to break out before, or break down in this case, before we actually look to enter the trade, because the quickest way to lose money, in my opinion, is to bracket the market. And that is place a sell order below and a buy order above. And as you can see, you would have lost money pretty much straight away. So we've identified a range trading opportunity now. And what we're looking for is price to break out that range bound location. So it breaks out that range bound location at this point of the chart. We've identified the range, and you can zoom into the lower time frames and basically look for that breakout pullback setup. My first port of call typically is the 89 tick chart. If you don't have those available, that's a 2 or 3 minute chart is is good enough for that. But that's my first port of call. Alternatively, you can then look at the 15-minute chart and so on as you go up the time frames. So following the sequence through, what we can identify is the phases of the market. Price is making higher swing high, and a higher swing low. So we can identify that price is making higher highs, higher lows. At this point of the chart, price is trending, and it continues to trend even during the overnight session. We do get price making higher low, and for the majority of price action, it does make lower high, lower low sequence. So again, not quite your stereotypical overnight range where it's quite typically confined, but during that overnight trading session, there was a downward bias. So you've got high, high, low, lower high, lower low sequence. At this point of the chart, I'd be thinking to myself, all right, well, hold on, we've got the overnight trading range at this point of the chart. I'm not around to trade anyway. So, what opportunities are there available to me? So I can look now to use that, potential directional buy shift as my range. We know it's the overnight trading session. It's a less active time period, but price is, so far, it's biased to the downside. So I can look for breakouts through the low of that range, or breakouts through the high of the range. And as we can see on the 60-minute chart, it did try and break out the low, break out the high, and eventually try and break out the low again. And as we can see, the end results, price start to move down. So the phase of the market is, at this point of the chart, price is started to try and trend down. It did make a higher high, which voided this directional bias to the downside. It then went to the upside. So what we're looking for that to be confirmed as a resumption of the uptrend is high, low, higher, high sequence. That didn't develop, and price basically flipped back over to the short side. So then we've got swing low here, bar preceded and succeeded by higher lows, bar preceded and succeeded by lower highs. There's the bias change. Price is now confirming for me on the 60-minute chart that price is now pointing down on the charts. Coming into, this is Friday, by the way, just for your reference. Coming into the overnight session, price has formed swing low, swing high, and so far, going into the end of Friday's trading, was contained within the previous swing high and the previous swing low. So at that point of the chart, going into the end of Friday, you wouldn't be mistaken for thinking that price could ultimately continue to be range bound during this location going into Sunday night and Monday morning session. Now, as it turned out, that wasn't the case. We saw a gap down, so how can we take that into account? A bar preceded and succeeded by higher lows is there, and a bar preceded and succeeded by lower highs is there. It's all on the same bar in this case. So what we've done is price has made a higher low. What we've seen is price makes a higher low and a lower high within the overnight trading session. Again, this is the overnight trading range on Monday morning. The overnight trading session now has confirmed that price is range bound. It's not making a new high, it's not making a new low, but it is making a higher low and a lower high within the previous swing high and the previous swing low. There's our range bound location for the overnight trading session. So we've now identified our range for the overnight session. We can very simply wait for a breakout pullback setup. Price breaks through the 205.43 zone. You're looking for the first bar not to make a new bar low. And basically that's your pullback on the lower time frames, and that does develop. This is something that we traded in the live trading room yesterday. Monday. So we've got the breakout pullback setup. Again, entries taken typically on the 89-tick chart or the 15-minute chart, depends on how the chart unfolds, but price has been range bound. And again, following the sequence through, it makes high low, lower high. It does try a higher low, high high sequence, but all those swing highs, those two swing highs, two swing lows, are within the previous swing high and the previous swing low to be made. Price is range bound. So now what we're looking at is we're looking at the breakout pullback setup at this point of the chart. So there's your breakout location. You're looking for the first bar not to make a new bar low in the form of a pullback, and that provides your entry opportunity to trade the range. As price ebbs and flows back and forth, price makes a lower low. So price is now trending. We're now in a downward trending motion. It's making now lower highs, lower lows. It's moved out of its range. It's making lower highs, lower lows. The market is now trending and continues to do so. It makes a lower low, lower high, higher low, and a lower high. So we've got a lower high and a higher low within the previous swing high and the previous swing low. So what we've done is during the overnight trading session, we've managed to identify our range bound location. So what we've identified so far is phases of the market. Price is trending up, price is trending down, and Kipper will come on to that question in a moment, jumping the gun ahead of ourselves. So we've identified range bound location. So price is contained within the previous swing high and the previous swing low. Now you could be mistaken, or you might be mistaken for taking this as your overnight trading range, and nothing wrong with that, but price is contained within the extremities of the previous swing high and the previous swing low. So that's my range bound location. So that's the area based purely on price action that we've identified a range trading opportunity. Now in this case we had a little bit of messing around yesterday with some news. So price makes its lower low, goes up to the lower high, and coming into today's session, and we'll look at that now. So price makes swing high, swing low, and it makes lower highs and higher lows within the previous swing high and the previous swing low to be made. That is my range bound location. It's contained within the previous swing high and the previous swing low. It's making a lower high and a higher low within the previous swing high, the previous swing low. That's my range bound location. That is where price is contained on the chart. So now we've identified today's most recent range bound location. Let's just mark up the most recent one, and then we can start taking a look at some live examples. So for today's trading, what we've got is we've got an overnight trading range, and we can start taking a look at the lower time frames. So the first port of call for me is the 89-tick chart. So let's just zoom in slightly. So we've already got our range bound location. My first port of call is the 89-tick chart. And we can see early in the day that price broke through the 204.04 zone. And what we're looking for is for price to move beyond the trigger level for short opportunity. So the low of the overnight range, and I'm looking for the first bar not to make a new bar low. Let's just zoom in slightly so we can see that a little bit more clearly. The first bar not to make a new bar low. It's not actually this up bar because price has made a lower low on the bar. The actual first bar not to make a new bar low is there. That's the first bar not to make a new bar low for me. So that creates the entry below the event. So below the event is the pullback. And I'm looking for a short entry below 203.84. And for me, I place my entry in my live trading room at 203.80. As the chart unfolds, the stop loss goes past the event. The event is the highest point that price is retraced to after the breakout move. There's the highest point of the retracement after the breakout move. That is where my stop loss location is going to be. I'm letting the chart dictate where I place my entries and where I place my stop loss location. So it's going to go above 204.19 plus the spread and plus a few pips, to be fair. I like rounded up and down to the whole numbers. So for me, my stop loss went at 204.30 on the pound Swiss. So an entry at 203.80, stop loss at 204.30. I've got a 50-point stop loss, and I'm looking at the potential for the day's move. So I just want to jump back onto the 60-minute chart for a moment. So I've now got the entry located. Now, based on an average day's move, what I'm looking for is for price to move an average day's move. Now, on the pound Swiss, that's about 250 points at the moment. So quite conveniently, all this is, folks, is a fib retracement tool. And I've customized it. Let me just show you what I've done. So I've got the start and end points, the distance between the 0 and 100% line of the fib retracement tool set at a distance of 250 points. So I can see what the potential, just by literally dragging it over the chart, wherever I want to drag that, that's always going to be 250 points. So I know that my potential is down to 202.20. That's the potential for the trade. Let's just take a look at the 15-minute chart. So that's my potential for the trade. Now, the tick chart highlighted the entry for us, and we've also got the same, to be fair, we've got the same trade on the 15-minute chart. There was no advantage or disadvantage from using the tick chart or the 15-minute chart today. Usually we can get a quick low-risk entry on the 89 tick chart. If you don't have an 89 tick chart, a 2 or a 3-minute chart will do just as well. But we've also got the first bar not to make a new bar low on the 15-minute chart. So there's no advantage or disadvantage today on the pound Swiss. But nevertheless, the same pattern is still present at the same location. We've got the breakout of the overnight range low. Breakout of the overnight range low, looking for the first bar not to make a new bar low. That's the pullback. That's triggered at the same setup as what we saw on the tick chart. We're seeing that now in a little bit less detail. So the potential is based on an average day's move. 250 points or thereabouts on the pound Swiss is what it does at the moment. So I'm looking for a move down to 202.20. This middle line here, this is 65% of an average day's move, and this is relevant to an active trade management tactic that I've got in force at the moment. So that's relevant to the actual trade management. Right, any questions so far? I want to make sure that everyone understands the price action sequencing with the swing highs, the swing lows definition. And I also want to make sure that we understand how ultimately to identify range-bound price activity. Generally speaking, if price is making higher swing highs, higher swing lows, price is going up. Lower swing highs, lower swing lows, price is going down. It's trending downwards. When price is making neither new highs or new lows, price is range-bound. That range, or price potentially can be range-bound. Price will confirm as being range-bound when price makes a swing high and a swing low within the previous swing high and the previous swing low to be made. That will confirm that price is range-bound. The red lines are the trades that I've marked up. This is what we looked at this on the tick chart literally a few moments ago. This was the trade that we highlighted on the chart, on the tick chart. So we've got the breakout. The yellow line is the support low of the range that I've marked up. We've got the breakout pullback setup. The first bar not to make a new bar low creates the entry. The entry goes below the pullback event, so it goes below 203.84. Stop loss goes past the event. The event is the highest point that price should retrace back to. Trade eventually triggered. Stop loss goes past the event, and we're looking to try and manage the trade now. The solid red lines are the current day's high and the current day's low. They're automatically generated by TradeStation. No, I'm not waiting on the 60-minute chart for price to close beyond. I think it's a bit of a misconception, waiting for the bar to close or waiting for, 2 bars to close past, a trigger, the short trigger level. For me, the entry, let's just zoom in so we can see this in more detail. Let's just scroll through what actually happened. So in real time, what we're looking at, right, so this is what we're looking at in effectively this is what we're looking at in real time. Price needs to get down to my short trigger level. I'm looking for price to move beyond 20400. So that's actually developed. So there's my short trigger level. So price needs to move beyond. I'm not looking for a close past the short trigger level. I'm simply looking for a bar to penetrate that level. That's all I'm looking for. I'm not looking for a close. I'm not looking for 2-3 bars to close past it. I'm simply looking for it to penetrate that support level that I've identified. It could be 1 pip, half pip, it could be 10 pips, 20 pips, and the pullback ultimately may not develop. You know, we could get a runaway market. In that case, we just have to let it go. We haven't had a trading opportunity. So scrolling through the charts, we're looking for the first bar not to make a new bar low. It's not developed yet. As you can see, bottom right-hand side, that bar, the low of that bar is lower than the previous bar. That's not a pullback. Even though it's an up bar, it's not a pullback. There's the pullback confirmed. The first bar not to make a new bar low. The entry goes below the lowest point of the breakouts. And at this point, the stop loss is still developing. I don't know where the stop loss is going to be. It's dictated by price action. As the chart continues to develop, so far the highest point of the retracement is here, the blue line. Stop loss will go above that plus the spread. And that so far is the highest point of the retracement. That's the highest point that price retraced to after the breakout move. The trade triggers, 203.80. Stop loss goes in past the events, and your normal trade management tactics get employed. And we also know the outcome of this trade so far. So we've got a profitable trade. We've managed this. We've secured some profits in real time, and we're currently actively managing this trade. Let me just read the questions. Price made a new low to the range, but then reversed made a high. Yeah, that's a quite a valid question, Tim. So basically, if price, well, we've seen a few examples of that when I went through the 60-minute chart. But for example, if price broke out the low of the overnight range, but what if it broke out and then it rallied higher? Well, the long trigger is the higher the range. So although we have the breakout pullback set up, I'm just moved to the 15-minute chart for clarity. So although we have the long trigger there, the short trigger there, we can basically look for a long trigger above the higher the range. But currently, bias to short side. And to be fair, I mean, this is one of those situations where when we look at the 15-minute chart, we can see that price action was contained somewhere slightly differently, because the last swing low and the last swing high on the 15-minute chart is actually there. So you can refine that range slightly with the 15-minute chart. Now, if I'm refining a range, because it's quite obvious in this case that price action was contained, but looking at the 60-minute chart, the range high is there. On the 15-minute chart, what we have is the majority of the range bound location is between the previous swing low, the previous swing high to be made. Price on the 15-minute chart was trending down at that point. It then made a higher low and a lower high within the previous swing high and the previous swing low. So we can refine the range in this case today by looking at the 15-minute chart. So when you refine a range like that, so for example, the 60-minute chart gave us a higher range high. On the 15-minute chart, we've got a slightly lower range high, and it makes more sense. That is where the majority of the price action was contained during the overnight session. So if price had moved beyond the range high, then you'd be looking for a breakout pullback setup. And what you will have avoided is a false breakout. So that's the objective of waiting for the pullback. So an important question to ask yourself when you refine the range is to say to yourself, well, with the way that, first of all, when I place a trade, as you know on the blog and the article that I've written, I look to scale out 2/3 of the position quite quickly at 50% of the stop size. So if I've got a 30-point stop loss, I look to take 2/3 off at plus 15 on the trade. So that removes the risk, and I've managed the trade to a break-even point. So if I've got plus 15 on 2/3 of the position, minus 15 risk on the last third, they cancel each other out. That's a free trade. I've managed the trade. Instead of moving my stop loss to a break-even point, I've managed the trade to a break-even point by scaling out and taking some small profits quite quickly. So with that in mind, if I've refined the range in this case, one of the things that I will look to ask myself is, can I get a free trade on the next line of resistance? And we know that the next line of resistance is the 60-minute high that we marked up when we looked at the range potential on the 60-minute chart. So if I'm refining the range like this, I can look for a breakout pullback through the high of the range. Can I get a free trade on to the next line of resistance? The next line of resistance for me is yesterday's high, this where the solid red line is. That's yesterday's high. So that's where the 60-minute range told me it was. But the 15-minute range, it's a little bit more obvious where the overnight range is. So can I get a free trade on to the next line of resistance? That's what I would ask myself when I refine the range. So we've refined the range for a long trade. So if price moves through the high of the overnight range, I can look for a long trade. Now, do I have profit opportunity to trade that up to the next line of resistance? 204.70 and about 206. So we've got about 100 points distance between the overnight range high that we've refined on the 15-minute chart to the 60-minute range that we identified, which is yesterday's high. So we've got plenty of profit opportunity. So can I get a free trade on to the next line of resistance? Yes, I can. That means I can refine this range high for long breakout opportunities. Let me just read through the questions. Question is, do I always drop to the shorter time frames for the trigger? Yes, I do. My first port of call is the 89-tick chart. I use TradeStation for my charting in data feeds and also brokerage. So the tick chart, it most likely will differ from broker to broker, but they are actually quite good on TradeStation. If you don't have access to 89-tick charts, a 2 or a 3-minute chart will give you the same effect. Let's just take a look at that out of interest on the 2-minute chart and look at the same pattern. So we've got the same pattern on the 2-minute chart. You know, it's quite similar to the 89-tick chart, quite similar. Excellent. Sorry, just bear with me folks while I read through the questions. It is more of an open session today, so feel free to ask questions. Strong move up. Enoch, trader's trick entry, if you want to put a label on it, yes, that's what it is. Joe Ross was very clever. He patented the name. Trader's trick entry is just a pullback. That's all it is. It's been going around long before Joe Ross came about. These pullbacks, the earliest reference found for a pullback is about 1880. So they've been going long before Joe Ross decided to patent the name and trademark the name. But essentially, if you want to think about it that way, yeah, it's a trade is it's a pullback, 1 to 3 pullback, or a Ross hook, for example. Yeah, to be fair, Biggs, yeah, this is exactly what I go through in real time. We're looking at the breakout pullback setup. Looking for the first bar not to make a new bar low. My entry is going to be here. Stop loss is going to be there. I explain everything as I'm going through it in real time. Let's take a look at some of the other charts that we've been looking at this morning. Pound yen was one such trade. Looking at this on the 15-minute chart, and we can see very similarly that price was contained here between the previous swing low, previous swing high to be made. Majority of the price action was contained in this zone, and again we've got the breakout pullback setup. I can see that the breakout was there. Now personally, I was a little bit late on this move because I had a few issues this morning. So on the pound yen, let's just take a look at the 89-tick chart. 89-tick chart on the pound yen, we can see the breakout level. The breakout level there. My personal entry was a little bit later on. It was down at this level here at 205.30. So slightly late on the moves, just simply because I had a few issues this morning that I was just trying to deal with. So my personal entry was actually slightly lower. But we're looking at still the same thing. The first bar not to make a new bar low. We've identified a pullback, and we've managed a free trade on this with the scale out, and we're actively managing this trade. Yeah, the two pairs, they do move very nicely. They do move very nicely indeed. I do like the wider ranging currency cross rates, like the pound, yen, CAD, Swiss, euro, yen, pounds, Swiss, for example. They are my personal preference. Euro, dollar. Now, euro, dollar, quite an interesting trade opportunity to look at. Sorry about that, folks. Quite an interesting opportunity, range opportunity to look at. One of the questions I had I actually had a question this morning because on the video I've done for the breakouts, typically I'll tell people that if they're looking for a range, the overnight trading session usually starts about 10 o'clock UK time to about 6, 7 o'clock in the morning. To about 6, 7 o'clock in the morning. So one of the things that that can be identified from this is 10 o'clock at night. So your 10 o'clock range high and range low is actually there. Let me just mark off the time so we can see that visually. So 10 o'clock is about there, and 6 o'clock is about there. So this is quite important. So one of the things that you can get hung up on, so one of the dangers to try and avoid is if you're using a time of day to try and identify a range, one of the easiest traps to fall into is to be rigid with that time slot. If you're looking at the Asian session as your range-bound location from a time point of view, what we end up with is a situation like this, where price has formed a range overnight, but the time segment that you're looking at this portion of the chart, it's narrower than the overnight range. So if you're using a time to identify a range, it's very frustrating because the actual range is slightly wider. The overnight range, this is quite an obvious overnight range, so the actual range is actually slightly wider than the time, using a timed segment. So the time segment, the range for the time slots is there. And as you can see, the overnight range is quite a lot wider than the time segment. So a trap to try and avoid, yeah, exactly, be flexible. So a trap to try and avoid is don't get caught up on the time. I've produced a video on the breakout strategy, and one of the things to talk about is to look at this time segments, but don't get hung up on it. The range can start a lot before, and the range started at 3 o'clock yesterday afternoon UK hours, and it's only breaking out now at 10 o'clock. It's only breaking out now at 10 o'clock. So we've got the breakout pullback, the first bar not to make a new bar low has developed. So there's your pullback, there's your breakout high. So your entry is going to be above the high. Stop loss goes past the event, and so far, based on current price action, the event low is about 54.35. So at the moment in real time, what we're looking at is a breakout pullback opportunity. Now, one of the things as well to bear in mind is this is a counter trend opportunity. Previous day was down. We know that 65% of the time these overnight ranges are continuation patterns, but 35% of the time they're reversal patterns. It's a fact. That's just the way it works out. So how can we avoid false whips? And how can we take advantage of these counter trend movements? Well, first of all, we're not going to place a bracket order above or below, because if we placed a bracket order above, so above the high of the range, we've got in the trade, we've sat through a loss, and we're sitting through a loss at the moment. So by waiting for the breakout pullback setup, we're avoiding, first of all, whipsaws, and first of all, sitting through these potential losses that can develop. Now, it's only a paper loss technically, but the trade for me hasn't triggered yet. The entry is going to be above the breakout high. So this trade is one that's still yet to trigger, and that's certainly something that's worth looking at. Is the break to 154.20? They're too early. Yeah, it's available on the website. I'll get the link for that for you shortly. Yeah, again, the same question from before. So we've got a long breakout, so it's going to go above 154.81, obviously plus the spread, because you're going to have to buy, and we're looking at bid charts. Now, if price doesn't trigger that trade and breaks through the low of that range, then yeah, we'll be looking for breakout pullback setup to the downside. That's quite a valid setup. So what we've avoided, is a false breakout. And at the moment, it's not triggered the trade. It's not necessarily a false breakout. The trade technically hasn't triggered yet. But if price did break through the low of the range, that does provide a trading opportunity for us. So we're still waiting for a long trade to trigger, and breakout pullback through the downside will dictate a short trading opportunity. So going back to the three basic questions that we looked at last week, Where's price now? What's it doing? How can I get involved? So now ultimately we're looking at price action and identifying what phase the market is in. We can successfully identify those, answer those three questions. Where's price now? It's range bound. It's not making new highs or new lows. The range is at an ideal location. It's at the low of the previous day's high-low range, an ideal location. If price goes up, down, or sideways, what's the plan of action? Well, I've identified the phase the market's in. That phase is a range. The range is at an ideal location. So if price goes up, down, or sideways, what's the plan? If price continues to go sideways within the range, step aside. I'm waiting. It's a not yet situation. No action to take. If price goes up and breaks through the high of the range, I'm looking for a pullback entry. If price goes through the low of the range, I'm also looking for a pullback entry. So I've now got a plan of action for the three ways that market can go. Price can go up, price can go down, price can go sideways. I've got a plan, an eventuality, and a situation where I can trade any direction that happens. Typically, I'll stay out of sideways moving markets. I'm not a range trader, I'm a trend trader. If price goes up, if price goes down, outside the range boundaries, I've got trading opportunities. There is potential for the euro to move between 120 and 140 points based on an average day's movements. It's done about 35 points overnight. Sorry, it's done 35-point high-low range during the overnight trading session. So I've got potential for about 100 to 110 points. JS, just one final question, and then I think we'll probably have to wrap up. I think we've got 5 minutes left, so we can take some questions and answers. So I have 1 and 5 minute charts, which is a preferable entry. Personal choice. You know, the thing that I try and emphasize to people, there is no right or wrong way to trade. There's only what works for the individual. So for me, I like using 89-tick charts. That was my personal preference. Before that was available to me, I used to use a 3-minute chart. Before that was available to me, I used a 5-minute chart. Let's take a look at a 5-minute chart. You know, there is no right or wrong way to trade. If you don't have 89-tick chart or a 2 or a 3-minute chart available, use what is available. 1 minute, it might be too messy for you. 5-minute chart might be just right. You know, it really is personal preference. I know it's a cliche. It really is a cliche, and it sounds like I'm trying to avoid the answer. But that is absolutely right. What is your preference for? Do you want to trade a 1-minute chart? If the answer is no, then don't trade a 1-minute chart. A 5-minute chart might give you more time to think about the trades that are developing and to place the trades, you know, physically place the trades, whereas 1 minute might be too fast for you. So quite logically, you've managed to filter that down between a 1-minute and a 5-minute chart for your entry time frame. Again, guys, you know, the predominant trend is down. So yeah, I mean, what you can do is you can see, well, overall the trend is down, so I'll look for a short trading opportunity. But we know 65% of the time it's a continuation, but 35% of the time it's a reversal. Now, if we're not looking for to bracket the range and avoid false breakouts and whipsaws, etc., and we're looking to trade the breakout pullback setup, this is a counter trend movement technically because it's counter yesterday's overall trend on the euro. You know, 35% of the time it's a reversal pattern, so why not take advantage of it as a reversal? Why not take advantage of it as a reversal pattern? So if the trading opportunity is there, you know, take it. But if you don't like trading counter trend, again, what you're starting to do now is filter down the strategy to suit your personality. So for you, it might be a situation you don't want to trade against the trend, so you're going to go with the trend. So the only thing you're looking for in that case would be a short entry on euro dollar. So you're looking for a bit of the low of the overnight range. So straight away you're filtering down and making the pattern your own, and that's what trading is all about. This is how I trade these strategies. But for you yourself, it might be a case where you don't want to trade counter trend, and that's a decision that you have to make. How do I pick my pairs to trade? I've gone through something that I call clean chart, messy charts, and I'll try and pick a quick example. Let me just get the 60-minute chart on. What I did, I went through all the currency pairs that I trade. Started off with the daily chart, for example. I look for a clean chart, messy chart, so AUDCHR. So a messy chart for me would be Aussie dollar Swiss at the moment. That's quite messy, but quite a lot of spiky price action. You can see Aussie dollar Swiss. There is quite a lot of spiky price action again. Look at the last couple of days. Every other bar's got a spike on the wick, a spike on the candle. Whereas you compare that to euro dollar. The bars are quite conveniently showing nice trending price, and the open and the close of the bars are at opposite ends of the candles. The spikes are at the turning points in the market, which is quite interesting to see. So that's a way that I visually filtered down the trades. Currently, I've got about 12 currency cross rates that I look to actively trade. Any more questions, folks? Because to be fair, the session for me is over, so I will take, as I said, questions and answers for a few moments. But is everyone happy with the logic behind price action sequence? How to use that to identify trading ranges and identify the phase the market's in? And ultimately, how we can then use that same phase, that lower high, lower low sequence, to identify trading opportunity. That lower high, lower low, or high high, high low, that's a pullback. That's what we're doing. So if there's any questions, I'll take them now. Otherwise, I'll continue on the blog. And keep your eye on the blog for additional comments and updates. And if anyone's got any questions or answers about the session, I will take them on the blog. But that's it, folks. That's really price action and how that ties in with what I do on a daily basis. If you want to take a look at some of the free stuff on my site, cheeky little self-promotion. There's some good information there, and if you look at the breakout article, there should be a video link at the bottom of it, which you can watch the video version of the strategy. I think we've got 2 minutes left. So when news comes out, typically I'm usually in the trade before the news comes out. I mean, today, for example, pound Swiss, we had some news at 9:30. I'm already in the trade. For example, when the news comes out. There's very few news items that I'm bothered about. The only things that I'm cautious with are things like non-farm payrolls and interest rates. Typically, if I'm in a trade before the news, I'll trade through it. It doesn't concern me. Exactly the same way, I think, is the answer you're looking for. Trade exactly the same way. A little bit of common sense, though. I'm not going to place a new trade 5 minutes before the news for any news item. Just a little bit of common sense. And non-farm payrolls, for example, if I'm not in a trade 2 hours before non-farm payrolls or interest rate announcements, I won't look for a new trade. I want to give the trade the opportunity to move before the lull, before a major news announcement. Because typically what we see ahead of non-farm payrolls and interest rates is we usually see a lull for about 1.5 hours to 2 hours. So if there's no trade that's generated prior to non-farm payrolls, as soon as that 2 hour threshold's reached prior to the news, I'm not going to place a new trade on. Well, thank you very much, folks. It's been quite pleasurable. Again, expanding on how we look at ranges, and if there's anything further, please feel free to contact me. You can contact me via the website, via Skype, or via email. Thank you very much, folks.